when you're projecting something that you believe you can promise versus what the potential is. So I always used to flip the conversation, and I would go back to the founder and be like, I see you're raising $1 million. Would you really not know what you would do with $2 million? Those founders come back and she would say, of course I know what I would do with $2 million. I would double down on product here. I'd hire twice as many salespeople. I'd open up in 3 cities instead of 1. What do you think that would do to your revenue? Oh, that would really open revenue up. Like we would easily get to twice the revenue in half the time or whatever. Cool. That pitch is way better than what you just gave me. Why didn't you pitch that? Well, I can't promise that. Right. Nobody can promise anything. I can't promise that I'm not going to walk out of my apartment and a piano is going to fall from the sky. I can't promise that, right? But this is not a promise conversation. This is a potential conversation because you're sitting across the table from a VC who knows that only 1 or 2 of the 30 deals they do in this fund are going to return the fund. They don't know which ones, but they need to make sure that they all have that potential.
Hey everyone, welcome back to the Ignite podcast. Today we have Charlie O'Donnell on the mic. He spent 20 years inside rooms where funding decisions actually get made. First analyst at Union Square Ventures, then helping First Round open its New York office, where he sourced GroupMe, SinglePlatform, Moat, Ep277, and many others. In 2012, he founded Brooklyn Bridge Ventures, the first VC fund based in Brooklyn, and wrote first checks into over 100 companies, including Hungry Root, Pedal, Bridget, GoTenna, and The Wing, and others, building a reputation as the most accessible early-stage investor in New York. He made his final investment in early 2023, walked away from the fund model, and has spent years since coaching emerging VCs. I'm looking forward to that conversation, and running the next NYC community. This spring, he just published Founder Unfriendly, What Investors Won't Tell You About Getting Funded, which hit #1 in the new release in the VC category and carries a cover blurb from Brad Feld. Very cool. Thanks for coming on, Charlie.
Thanks for having me. I appreciate it.
Yeah, so I'd love to get your origin story. It's so fun to kind of hear VC stories because they're so different. But what is your background?
So actually, my first job in venture capital was on the institutional limited partner side. So if you're out there pitching VCs and it's frustrating, keep in mind that they also have to pitch to raise their fund. They don't necessarily have to do it as often as you do, but we were the big pool of money behind a lot of the top tier names that you've heard of. GM had been investing in venture as an asset class since the 70s. So Union Square Ventures, when they raised their first fund, came to pitch to me back in 2004. So that was my entree into venture, is funding funds and then eventually joining a fund.
That's amazing. How did that, was that just right off the college campus? Like, how do you land a job like that? That's pretty amazing.
It was kind of funny. It was actually a high school internship. So my high school, which was pretty smart actually, after we had applied to our colleges, they basically kicked us out. Because, you've applied to your schools, you're just kind of hanging around campus, like not really paying attention, sort of the senioritis thing. And so they're like, okay, we got to get you guys out of here because all you have to do is pass. And so you're just kind of mailing it in. So you got a choice of either doing a community service project or working on an internship. I chose internship. Wound up working at the General Motors Pension Fund. And I actually, all throughout college, because I went to school locally here in New York at Fordham, I bounced around a bunch of different asset classes. And the asset class that just happened to have an opening when I graduated was the venture capital and private equity group. You might think, what luck, that's super glamorous. Keep in mind the timing. In 2001, I saw 10 negative quarters of performance before I ever saw a positive one. This was just the period of shutting down .com busts. And depending on when you had raised your last round, you either had like 2 years of money left or 2 months of money left, but you definitely weren't a viable business. So the VCs would sort of come in and every quarter they'd be like, okay, we did a triage and we think like a third of this portfolio is going to make it and return your money. And a third is kind of on the fence and a third is just, garbage. And then the next time we met them, we're like, okay, well, actually it's a third. And after 3 or 4 rounds of that, they're like, I don't think our 99 vintage fund is going to return capital. Let's look towards the future.
Wow.
And so it was a really tough space at the time, but
what a tough conversation, right?
Yeah, for sure.
And I think there's some really famous examples of, I think like it was like Benchmark around that time, just decided like, we're not going to take management fees for 2 years and we're going to deploy that and save the fund, basically. There's a lot of famous examples of that, but what a tough conversation with your LPs. Hey, you know that money you gave me? I'm not going to be able to return it.
Well, the thing that helps with some of them though is you think about a fund like Excel. I think it's like if their 1995 fund or 1994 was like a 25x returning fund. So if you return 25x and then even like a really terrible fund,
you have a 1x fund or whatever. Yeah.
Right. Like even if it's less than 1x,
12x.
Net, you're still way ahead, right?
Yeah.
So you can take a mulligan on one fund, maybe not two.
Yeah, you got caught by the market there.
Right. But also the timing makes it really interesting. So what wound up happening is normally in any given year, maybe like a quarter or a third of your portfolio would come back to market, but everyone stopped investing at exactly the same time, which meant everyone came to market again, roughly around the same time. So in 2004, something like plus or minus, 18 months around 2004, like 85% of our portfolio came back to market. So we had the unique opportunity to either say we want out of venture, like literally we're just not doing any new deals. And I think TIAA-CREF actually completely pulled out of the asset class. We want to double down, right? Like we could actually pull into these funds as other people are pulling out. Or we're still into venture, but we don't like these managers and we're going to switch out our managers. And so there are a lot of emerging funds like Union Square Ventures, Spark Capital, Emergence. They were all sort of born around this time period of, and several of those firms had people who came from other firms. Todd Dagris came from Spark, and there was a whole reshuffling of the asset class that resulted in a lot of new funds around that time. So it was actually really quite interesting to be an analyst at a institutional fund looking at the whole space and trying to figure out, like, is this still viable? What names do we want to go into? So
working at a pension fund, what did watching this flow of institutional LP capital inside teach you most that CGPs never see?
So I have to admit, I'm a little skeptical when people say, the returns haven't been great. Will LPs pull out? Because the one thing when you're looking across asset classes is if you think somebody is potentially a little skeptical about venture, you have to ask yourself, where else are they going to put the money? Right? Because if you're managing
and get that kind of alpha, right?
Right, exactly. Yeah. Right. And so, you look at valuations and public equities, right? You're not going there, right?
Even late stage private markets now, the valuations are pretty crazy.
For sure,
200x
right?
again, like they were in 21.
You look at interest rates and real estate, like there's just not a lot of places where you could actually tell yourself a story that if you have good managers to back, that you can make this outsized return. And so, this is where the venture train keeps on running, and why some of the bigger funds continue to return capital, to continue to raise capital, is because they have big funds, they have prior outperformance. And so if you have an allocation into the Union Squares and Lightspeeds and, Andreessens and Benchmarks and wherever, you're probably not going to give that up, actually, because you don't have another opportunity that you can tell yourself that you're going to get like these kinds of returns out of. So that's one. I think the second thing, and when I moved from the General Motors Pension Fund to Union Square Ventures and got to talk to founders about who they wanted to raise their A and what they thought of different funds, I realized, and maybe today it's a little bit different because there's more transparency in the market through social media and newsletters and LinkedIn and all this other stuff. We were so disconnected from that next great entrepreneur who's choosing where to go pitch their fund. And, our perceptions of the market were years, like almost a generation behind, actually, because LPs don't have relationships with founders, and not just the successful founders, right? Like that next founder, the VP of engineering from Plaid who discovers some infrastructure thing and trying to implement AI across like fintech backends or whatever. Like that's the decision maker you need to tap into. And like, the Massachusetts State Pension Fund or whatever is like, they're not talking to that person. And
they also just don't have the infrastructure, right? To screen thousands, if not over 10,000 deals like GPs do,
Right,
and
right.
I'm actually going through and revamping some of my slides and kind of telling that story of the funnel, right? The deal flow funnel, right? Because we're a very high volume investor investing in 100 a year across funds 2 and 3. And, it's very much an education process of like, how are you seeing 10 15,000 deals a year, right? How are you like physically able to do that, right? And telling that story and that infrastructure in place. And it's an interesting, like, you could almost say like VCs are kind of like middlemen a little bit. Yeah It's like you kind of sit in the middle. Like maybe if the LPs had all the same infrastructure, if they just took all my systems and like hired an analyst, maybe they can do the investing themselves. But I think there's like also this like persistence of returns in VC because the deal flow in your network gets better over time, right?
Well, yeah, right. It's sort of like when you get a chance to see what greatness looks like, you're part of a rocket ship outcome, then you surround yourself with people who also have that experience. You may not have been the founder, but maybe you were on a team that like sort of understood what greatness
There's a little bit of survivorship bias, right? Where you kind of like keep surrounding yourself with winners, and eventually all you see is winners all the time, right? That's one of the only asset classes where returns kind of persist because of that. Versus like in the public market, it's hard to like beat the market over time.
Right.
But in venture capital,
this is a relationship-based business.
Yeah, it's like, What did you learn at being the very first analyst at Union Square? I mean, you're coming in pretty green from the LP side. Like, what did you have to unlearn, and what were some surprising lessons in that role?
I think the biggest thing is how much of the knowledge was sort of locked up in people. So I came from a world where I had the Bloomberg terminal on my desk. I could call up any, trade desk and get the, sell side analyst report.
Give me your bid, ask on this, and
and the sell side analyst report on, whatever security sector and all of this sort of stuff. When I went to USV, it's like, these are sectors that barely even exist yet, and they're being created as we speak. And like, who knows something about them? It's some enterprise buyer or somebody that, there isn't a report written about this. And so very quickly, I realized if I was going to be useful to the fund, I had to network. I had to get out there and be in the community and talk to the people who were pushing these ideas forward and just get out from behind the desk, really. And so that's one of the reasons why I became, more public on social, started running events. I had to create the community in New York in 2004 and 5 that was necessary for me to learn, actually. And so I've always been sort of a community creator and people connector because it was by necessity, right? Like, I need to surround myself with the people I need to learn from so that I can be good at my job. It's not the kind of job you can do from behind a desk. I mean, now post-pandemic, AI, screening, harmonic.
I just sit in my pajamas all day and take Zoom calls, basically. But
Right. But at the time, you couldn't do it that way.
Yeah, not 20 years ago. That's around the same time I lived in New York as well. Had dreams of, working on Wall Street and all that stuff. And I wish I would have gotten to VC then. I have in my notes, you said you carried the privileges of being a white guy, but didn't grow up with money or an Ivy network. How did you talked a little bit about creating that network. What do you think it takes today to kind of build that network from scratch?
So first of all, it takes confidence. You have to first convince yourself that anybody wants to meet with you. So I think confidence is a big thing. I think you have to act as if and be willing to reach out to people and assume that you can create value for them if you don't have the background.
Confidence will take you all the way to the presidency is what I like to say.
Apparently. Whether it's founded or you're well founded or not.
Yeah, misplaced confidence. No, I know the best people. I'm the best. I'm the best at everything.
Exactly.
President,
I think one confidence hack is that when you create the opportunity for conversation from people, it's not necessarily, you're actually doing somebody a favor. And so, it's not why does this person want to talk to me, but am I going to create a space for this person to share their ideas? Because, everybody's got to feed the beast every day now, right? Like the prior professional Rolodex that we had in LinkedIn is now a social network where you need to like look smart every day. And sometimes you wake up and you've got nothing, right? But if somebody comes along and says, hey, I'd like to interview you and I'm going to share these clips and we're going to spotlight what you're thinking. You're going to have an opportunity to put something out there or an in-person event, right? Like you might get asked a question at an in-person event that like really inspires your thinking, changes direction, who knows who you might meet. So creating those opportunities for someone is actually a really valuable offer. It's not an ask. And so I think that is really incredibly important. But, not everybody feels that way, right? Not everybody lives in a kind of abundance world where something good could happen when I take time for you, right? That's a very like white collar kind of, up and to the right sort of approach.
Right.
Versus like, hey, if I waste your time, you could have been out on a plumbing job fixing something. And there's like the only upside when you're a plumber is to get paid for your time, and time is money, and that's it, and everything's sort of a very limited kind of upside world. So I think that is the number one approach, and the willingness to just ask a lot of people. Like I do this pre-Series A offsite, this 1-day conference where I get about 14 or 15 check writing Series A VCs, partners, select principals, and we literally kidnap them. Like they're supposed to be there the whole day. They can't walk off after their talk the way typical panelists might be. And so it's a big ask. But when we make that ask and we get those people, when we get partners from NEA and GV and USV and Lightspeed and all these other folks, then founders really want to come to it. Actually, because these folks are going to be here all day, right? So to get 15, yeah, we need to ask about 70 or 80 VCs, and does the timing work? And are they going to be in New York? And can they spare the day? And are they convinced that it's going to be valuable for them? And so like, I don't mind getting 50 no's for this event because I know that I'm going to get people and it's going to work out. And we've now done that event 10 times. I'm sort of used to it. But, when you're reaching out for 2 or 3 weeks and you're just like, oh my God, I have one
Not sure if I'm
person
going to get this thing put together. Yeah. I know. Yeah. It's funny. You mentioned something there, which I want to tug on, which is the, sometimes you wake up and you got nothing, and there's days as a VC where I wake up, I'm like, man, I really don't want to go to work today. I just want to, cancel everything and just go back to bed. But then I meet like some amazing founder, just working on the coolest thing. And I'm like, this is my job. This is what I literally get to do. And I, it's kind of like going to a party. Sometimes you don't want to go to a party and you're just like, I'd rather just stay home, watch Netflix, just want to like just veg out. And then you always go and you kind of meet somebody cool and you're like, oh, I'm glad I went. You always come home from a party like glad you went. And I think like being a VC is like going to a party every day. You're like, sometimes you don't want to go to the party. You just want to introvert. I just don't want to like talk to anybody. My wife's always making fun of me because she's like, why don't you like know like our kids' friends, parents' names? I'm like, this like my job is to meet people all day long, so I just want to introvert, but I'm always glad I went, to work.
Yeah, no, I agree. I agree.
So tell us the story of First Round. So you opened up the first office there.
So yeah, I got hired by First Round. It's pretty random actually, because there wasn't really a job opening. I had started a company after I left Union Square. And I wasn't particularly good at being an entrepreneur, and I kind of muddled through it. And we were down to our last negative $30,000 in capital. I maxed out on my credit cards when I landed at First Round.
What was happening financially?
So yeah, I had started a company, and it didn't really. I started a company in 2007, worked on it for a couple of years, didn't really work out. Tried to pitch in October of 2008. I mean, like literally I was in
That's
SF.
the I was following. Yeah.
Yeah. I'm literally in SF and there's a VC sitting across the table from me, just staring at their screen going like, it's like full of red numbers. They said, man, are you watching the market? It's a bloodbath out there. I was like, no, because I don't actually have any money. So it's really unfortunate that your $20 million nest egg is now 16. I guess that's really rough for you. And they're like, yeah, why don't you come back after the inauguration and see if the world is still here? And I was like, I literally have no idea how I'm going to make it the next 5 or 6 months, right? So right around the time we realized we had to put this thing to bed, I was helping a friend, Dennis Crowley, work on the pitch deck for Foursquare back in 2009. And it came down to first round capital and Union Square Ventures. And I had sort of unintentionally touched off a whole VC race to fund this company. I wound up blogging about it. And then Fred Wilson, who I previously had worked for, picked up on what I had wrote, and then he wrote something about it. And then MG Siegler, who was then writing at TechCrunch, saw my post and then saw Fred's post, and then two dots make a line. So Foursquare must be the hottest company trending out of New York so far. And then all the VCs start swarming like, hey, New York is still here after 2008. That's cool. What's this mobile social app that's the next big thing? So everyone is like really excited about this company. And when the dust settles, USV wound up funding it. And First Round had reached out to me and they said, hey, we add a lot of value to our companies. We have some really smart people here, but we feel like we're not as plugged into the New York scene as we kind of need to be. Like, how do we do that? And I was like, you need a person on the ground here. And New York's kind of a funny ecosystem. It's not like the Bay Area. You can't just like swing by Y Combinator demo day and meet 80% of the people you need to meet. There's no sort of inner circle in New York. For as much as you think you're part of an inner circle, maybe you're in the inner circle of prop tech, but you're not in the inner circle of ad tech. And then you're not, in the, Cornell runway postdoc program or the network surrounding BetaWorks or what have you, right? Because the New York tech scene is very much like embedded in various sectors. There isn't sort of a center of the community. And so you just need to kind of go house to house here. And in those conversations, they were like, okay, sounds good. Like, do you want to come and hang out for a year or two? Like, we don't really have an opening, but, we could use somebody, doing the footwork. And so I was like, great, because I'm going to max out on my next credit card bill and I need a full-time
I
paying
can't get another balance transfer. So this sounds good.
Yeah. I'm tapped out. And so it worked out. The timing worked out. I was there for a couple of years. I did 8 or 9 deals while I was there. In that period of just 2 years, 2 of them exited. So GroupMe sold after a year and SinglePlatform sold after 2, had a bunch of markups, felt like I was shooting fish in a barrel. I mean, I felt really smart based on those
coming out of a
years.
Financial crisis is almost like the best time to be an early stage investor, right? I mean, I experienced this because I kind of got into the industry in 2020, 21. So I saw the big run up and then I closed my first fund in 22. So as I'm deploying, all of a sudden it's a great time to be an early stage investor. Right?
You know what that first round of GroupMe was done at? 2.83.
2.8. 2.8?
Yeah, it was $865,000 on a 2.8 pre.
That's crazy. Priced, right?
Were they notes or priced? Yeah. I don't remember actually.
A convertible note. Yeah.
Yeah, I don't remember. I have to go back and
2.8 pre. Yeah.
2.8 pre. So at an outcome of like 70, it was actually a pretty decent return. I mean, small dollars, and it wasn't WhatsApp, but if you were
what do you think of price sensitivity versus insensitivity in early stage? I mean, this is like a really good example. Like I've met some early stage VCs, they're very price sensitive. I don't go above 5 caps, which kind of shuts out a lot of the high quality market. And my stance has always been, I'm just a price taker. I'm a small check, right? You just tell me the price, whatever, and I'll maybe get an MFN or something like that. Yeah, where do you come down on the price sensitivity argument?
There's so many examples where, like, when I was at Union Square, we had a whole conversation about whether or not Indeed was too expensive. And Indeed was like, it was like the founders wanted 4 on 12 and we had not planned on going above 10 or something, like that. And
splitting hairs. I mean, you're just splitting hairs over 20%,
Yeah, but you know what though? Like, you didn't really imagine at that time that you could sort of guarantee the $1 billion outcome. And so
they were much rarer back then.
They were much rarer. And, so you have to draw the line somewhere. And, and that was a company that did not raise after that round. So when it was $1 billion outcome, it was actually a really phenomenal outcome because there wasn't dilution in between, that outcome. So the problem is that you imagine missing out. It's the positive skew of the big outcomes, right? Like, if you were an Anthropic investor, almost at any price, that first round, you would be generationally wealthy by being in that first round.
Yeah. You'd
right?
100x your fund, right? That's what I like to say. Put a 25K check in Anthropic's worth $1 trillion today. It's worth billions. That 25K check's worth billions of dollars after dilution. I mean,
Yeah,
it's an insane return.
yeah. But then does that mean you should just go pay $100 million pre for every pre-seed or seed stage deal you do? Like that's not
Well,
right.
they have a C in front of their title, and they leave one of the AI labs, maybe, right? Maybe
Yeah,
it's a billion. Maybe you're investing at a billion pre. You know?
I think of it this way. If someone were to pitch you a fund based around this decision, would you invest in it? And so I go back to like, the Instagram round, the Josh Kushner Thrive Capital 2x in 4 days or whatever it was, right? The $500 million, valuation that the flipped 4 days later for $1 billion, which got him a whole lot of press. And, hey, 2x in 4 days is, that's loan shark returns, right? So that turned out pretty well. But if I turn around and I said, I'm pitching a fund, and this fund only invests in companies with no revenue at $500 million valuations that have only one logical acquirer, and we're going to do that 30 times across the fund. Do you think that would be a good fund to invest in? Like, probably not.
You have to be very lucky. Yeah.
Right? Like, that's not a decision that you could do 30 times. And so that's kind of where I think the way I look at this is, can you defend that decision over and over again? Like, if you're like, no, then your default should probably be no, and you probably shouldn't be in the market. Now, that doesn't mean you can't stray from it. But if you have a decision that you can't necessarily replicate, right? To go back to that example of, if you were a C-level person at a company that's probably going to IPO at $1 trillion, well, you're just not going to get 30 opportunities to back somebody like that, right? So
Yeah.
maybe
If you're
that
lucky,
valuation,
maybe
that's
one in the fund is like that, right?
right. And also, by the
Yeah.
way, you're in preferred, so that changes the nature too. So we're quibbling about price, but that's a fully diluted price. You are also the first money out.
Right.
So you have a floor.
Downside's kind of protected a little bit. This is something that I want to tease that out, that a lot of people don't understand, that I've noticed. I've made 300 and almost 50 investments now over like a 7-8 year period. Is even when startups they wind down, they shut down, and they sell for assets, basically, you normally kind of get your money back. Maybe
You
50
get
cents
something.
on the dollar, maybe $1 on the dollar, but because you're preferred, you're kind of first in line, unless they have a bunch of venture debt, which I won't get into. But
Right. It depends. Like,
it
especially
depends.
early,
Yeah.
like before they raise something big, there's acqui-hires, and,
Right.
maybe they build something useful that they flip to somebody. I mean, I had a company actually reach out to me that was sort of about to go under. And then somebody randomly at Staples reached out to me, and they're like, oh, hey, this is like a cool app for, creating some interesting cards. And, it was sort of a little bit of like it was a version of Canva before Canva. And Staples reached out, and we were basically on a like last few weeks of money. And I responded back. I was like, listen, like, this opportunity is gonna disappear. Like, you guys need to get on your horse. And they came back, and they wound up paying $3 million for the assets of the company and the team, and everybody made their money back. And the founder put a little money in their pocket, and they closed the whole deal in like less than 30 days.
There you go. Yeah, magic can happen. So, what happened after first round?
So there was no real room at the firm, right? These firms don't grow. Some of them don't grow forever.
Yeah, I'm like on fund 3 and I haven't grown.
Right.
It's
Exactly.
really hard to grow a venture. It's
Right. So if you picked up someone, if you had some junior person working with you, there's probably no partnership opportunity. And if you're not a partner, you basically don't have a career in venture. And so, I had a decent track record, and I poked around for some other people's funds. I was like, I don't love the idea of going to work for somebody else again. And where my upside is basically capped. Like, you go and work for somebody whose name is literally on the door. It's never going to be your fund. And so I had a network. I reached out, and I was like, I think I'm going to do this on my own, set up a small fund, reached out to a ton of folks, and opened up Brooklyn Bridge Ventures. The premise being that, I was going to do a bunch of super early deals in the New York market where I was like exceptionally plugged in. And that as a solo GP, I can move faster and go earlier. And because it was a small fund, I didn't have to sharp elbow anybody out. You give me 30 shots at running into one of the interesting companies and coming out of New York, and I'd have an opportunity to get them. And so successfully raised a first fund. I actually raised 3 funds, did 105 investments from 2012 to 2023 or 4. What was my last deal? About 2 years ago. Now I'm just working on liquidating that portfolio. It was a fun ride, and it was lots of really interesting portfolio companies. It was a very different time period. Like I think about now, like what's going on. It feels like a completely different time period to invest than what people are doing right now.
Yeah. Yeah. Especially, it sounds like you were deploying Fund 3 during kind of like this run up and run down, right? Is Fund 4 still maybe out there for you, or are you're sort of happy to say, hey, I did my 3 funds. I've done the run. 3 funds is a lot of work. Like, hats off. I
And
know.
I'm going to be
like,
in this Fund 3 for a long time. Long time, right?
And that's what people don't realize is like, I'm still managing stuff investments I made 5 years ago, and it really runs 10, 15 years, right?
Yeah,
So
for sure. The big difference, especially being a first check investor, is now that I'm not screening new deals, I have a very different relationship with work. And so, if I were actively screening stuff, you might catch me poking around this browser window and occasionally glancing at an email, or certainly after I finish this call, I'd be right into my inbox trying to figure out what I missed. I have a 4.5-year-old at home. You can see the art on the back of her wall now, and I drop her off, and I do a couple pickups during the week, and I want to be focused on her, right? I want my attention to be there, and I think the reality is it's much more competitive now. Everybody's got a little sidecar fund and is a scout and doing all of this sort of stuff and hyper focused, and now you have to compete against the 27-year-old that you used to be, trying to be Johnny on the spot all the time, going to 5 or 10 events a week and being in all the WhatsApps and the Discords and, all of this other stuff. And most people who are 46 and do this, they either do one of 2 things. They either build a team and they go, hire the person to do running around, or they go a little later, right? They narrow the aperture and they say, well, if you don't have $1 million in revenue or you don't have working product or whatever, don't, I'm only going to look at a certain narrower portion of the window. And that's just not what I wanted to do, actually. Like, I like being the first check, being the first thing to stuff. And I don't love being on a team, to be honest. I don't love having to get approvals and collaborate. I like going at my own pace. And so I was like, okay, I won't enjoy the way I would need to do this now. So I'm just going to go find something else to do.
I love that. And so that is, becoming an author and coaching. So maybe you could tell us about that.
Yeah, sure. So one of the things I realized is that the job of a VC for every 100 people in a room is to go find the 1 or 2 people you should spend all of your time with. I don't love forgetting about the under 98 people. They're struggling to raise, and a lot of them are smart and hustling and have a kernel of something, but don't know how to pitch it and aren't familiar with how venture funds work, because why would anyone be familiar with how venture funds work if they come out of an industry or they come out of a university and a lab or what have you? And I felt like I had something to offer them. And so that's what Founder Unfriendly is basically written for the 99% of people who didn't just exit a company for $500 million and have VCs lining up for them, who, just pitched or they're about to pitch a bunch of VCs and they're getting, that's really interesting. And then nothing. Trying to figure out, like, are they actually interested or not? Or, why are they not getting back to me? Or what does this mean? Or I pitched 10 VCs. I got 10 different pieces of feedback and they're all conflicting against each other. Like, how to make sense of this.
Yeah.
Right. And so
too big of a market, too small of a market.
Right. Exactly.
Too much traction, too little traction. Like literally, too much founder market fit, too little founder market fit.
Come back with revenues. Oh, these revenues are service revenues. So these are the wrong revenues. Like that sort of thing.
Yeah. And it's like you've met a VC, right? If you've met a single VC, you've met a single VC. And so every VC has a different lens that they look at markets. But, what's the core claim in the book? One of the core claims is great companies get passed while mediocre ones get funded. So it's not that VCs are dumb, but What's happening there? Some of the good companies are getting passed, and some of the bad companies are getting funded.
Well, so there's a few things I want to jump into about that. Is that there are really great business ideas that are not a fit for venture, right? A company that throws off $5 million of free cash flow a year and grows moderately is not going to return any A's fund. And so, especially if it's servicey or, it's not something that's strategically important to a big acquirer or what have you, but it's certainly a company I would want to own 80, 90, 100 of if I were a founder, right? So there are some concepts that just do not fit venture as a financial product. And so there's a whole bunch of folks who look at the turn down of VCs and they think that VCs are saying like, this is not a good business idea, when it is in fact a very solid business idea that is worth owning and worth, continuing, but does not have the risk return profile for this kind of financial product.
Yeah. It's kind of like if it works, it's not going to be a $10 billion company. If it works, it's going to be a $50 million company. And if I'm getting into the company at a 5 or 10 cap valuation, it just does not pencil with my model.
Right, exactly. But if you're an individual angel investor, or if you're putting your own capital in, like that might be a really nice outcome for you. And so that's one set of companies. There's another where the underlying idea is quite good, but you have just not successfully indicated to VCs that it is your intention to grow a big company or that possibility exists. And so many founders kind of come to VCs and they say, I have this. What do you think? Is this good? And that's essentially what their pitch sounds like, versus saying, my intention is to drive to a company that is going to do $500 million in revenue. Because if you come up to a VC and you're like, I have this, is this good? And then there's somebody else who says, I am staring at an opportunity to drive a company to $500 million of revenue in 8 years. That could actually be, across some aspects, a worse idea. But you have just indicated to the VC that, like, here is my intention, I'm quite capable. And a VC is not going to assume that it is your intention to drive something to a $500 million idea, especially because doing that at that trajectory also increases the downside. It increases the chance of a zero. So some founders unintentionally signal that they don't want to take those risks. So for example, I had a fairly diverse portfolio of founders. And one thing I see for founders that don't look like me, whether it's female founders, founders of color, is that, thank you, society, but we are sort of programmed to imagine that anybody who doesn't look like me is less aggressive, is less ambitious, right? And so if you go in and you're a female founder and you present a roadmap that, like, either only has the next 2 years of financials because that's the round you're raising now, and that's where you feel confident about where you're going to spend the money and all of this sort of stuff, and like literally leaves the rest of it open, or has the forward trajectory, but it is quite conservative because your perception is, I'm under a lot more scrutiny than my male counterparts, so I don't want to screw this up. Right? I don't want to say that I'm going to get to $200 million of revenue and then have it only come in at 150 and then, I lose my job as CEO I placed, or all of this sort of stuff. Okay, I get it, except that you were literally walking right into the existing bias that they have, right? They assume you're not as aggressive. And then when you're projecting something that you believe you can promise versus what the potential is. So I always used to flip the conversation, and I would go back to the founder and be like, I see you're raising $1 million. Would you really not know what you would do with $2 million? And I'd have those founders come back and she would say, of course I know what I would do with $2 million. I would double down on product here. I'd hire twice as many salespeople. I'd open up in 3 cities instead of 1. Well, and what do you think that would do to your revenue? Oh, that would really open revenue up. Like, we would easily get to twice the revenue in half the time or whatever. Cool. That pitch is way better than what you just gave me. Why didn't you pitch that? Well, I can't promise that. Right. Nobody can promise anything. I can't promise that I'm not going to walk out of my apartment and a piano is going to fall from the sky. I can't promise that, right? But this is not a promise conversation. This is a potential conversation, because you're sitting across the table from a VC who knows that only 1 or 2 of the 30 deals they do in this fund are going to return the fund. They don't know which ones, but they need to make sure that they all have that potential. And if I don't hear it from you, then I'm not going to assume it, right? Because I don't know that that's your intention to drive it. I don't know that's what kind of trajectory. I don't know that's how much you're going to put your foot on the gas. And so there are ways in which founders like sandbag the pitch unintentionally. And they need to understand what's going on in that room, what's being asked of you. What's being asked of you is to have an exercise that identifies the potential of this thing, not to promise what you know will happen.
So it sounds like what founders are doing unintentionally is thinking small, right? They're thinking small. They're like,
They're
hey,
showing, they might be thinking big, but they're afraid to say it.
Yeah. And VCs need to hear a big vision and a big plan, right? And it's like, you know, and this dial of money does different things to the outcome of the company. So that's really good advice. What other tidbits and stories can you draw out of the book for the audience?
I feel like you learn a lot about pitching when you're the parent of a small child who has the attention span of a gnat, right? Because it's like, go in your room and put your pants on. And then all of a sudden you hear, you know, the Yodo player going or whatever. It's like pants, just focus on just the pants, right? Like think of pants as fund returning outcome, right? Every slide needs to scream pants because we'll just kind of get lost, right? Like VCs have no attention span. There's not an IQ like licensure, like, you know, just because they're good at collecting money from institutional investors or whatever, it doesn't necessarily mean they're the smartest people in the room. It's usually the founders. And so from the beginning of the deck, the outcome needs to scream potential fund returning outcome. And I think there's a couple of reasons why that happens, right? Certain groups of founders feel they need to justify their presence in the room. Let me tell you how I got here. I was hired by this person. That's impressive. I went to this school. That's impressive. Here's how I even got into knowing about this, because you might question how I'm an expert in this, even though my background doesn't show it. Blah, 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 blah. 5 slides in, I don't know if you made any money. I don't know if this thing's even live. I have no idea how many signups. Like, you're busy telling me your backstory. And it feels like, you know, back in Sicily in 1922, kind of, you know, a story, right? So revenue, traction, whatever it is. The other thing, and I just, you know, jumped into showing revenue, and immediately people listening are like, oh, what if I don't have revenue yet, right? There's too many templates, too many shortcuts. People are not good at figuring out the interestingness of their own story. And here's the way I think of it. You basically have team, market, and traction. I'm not going to say product, because VCs are actually really bad at figuring out product, right? So they'll tell you like, oh, I have this thing and it's a box and it's blue. And it's like, I guess that I don't need boxes, so I don't know whether or not that's the right kind of box for this customer, but traction is a proxy for product. I wouldn't have used that, but I guess people are buying that, right? I guess people are engaging. You have 10 design partners? That's crazy. Like, why are people even engaging with you on this at this stage? This must be a real problem, right? Usually at the sort of pre-seed and even the seed stage, you kind of have 2 out of the 3. Like, you're very rarely going to have all 3. And so your particular narrative might be team and market. Like, we've assembled this incredibly like experienced group of people, and we're going after this space that you definitely want to be a part of. Well, now we haven't actually done anything yet, but don't worry about that, because this is the bet. You're going to want to make a bet on us in this space. Or we're awesome, and this is a train leaving the station. Forget about what you've heard about this space and everything that everybody's told you that this space sucks. The lead of this conversation is the 2 out of the 3, team and market. Or this is an amazing market and the train's leaving the station. Yeah, we're a bunch of nobodies, but that doesn't matter, right? Because we've got this 2 out of the 3, the lead. And so you need to craft your narrative so that the most impressive, the most important stuff is up front, and everything else is kind of played down, and you keep that energy level, you keep that excitement. And you need to spend most of that money most of that meeting talking about the upside. And this is where a lot of people get tripped up, because you may have seen the Harvard Business Review study that women get different questions. They get the downside focused questions. We've all seen that, right? And they say, well, how do I even get around that if they're asking me bad questions? Have you ever seen a politician speak in an interview? Do they ever answer the question that they were asked, right? They have their talking points. I'm so glad you asked me about jobs in the economy, because what it really comes down to is making sure that everybody is safe enough to get to work. And that's why my crime bill is just, what the fuck just happened? We were trying to make it an economic conversation. We immediately pivoted to putting more cops on the street, right? Because if you can't get to work, if you get mugged on the way to work, then you're not going to be able, the economy is not going to be able to function, right? So you need to make sure that you spend the bulk of the time in the meeting on the upside case, on the things that you wanted to talk about, on your message, regardless of what questions are happening in the meeting. And too often I see founders just let go of the reins and just let VCs control the meeting. And that doesn't work out.
Yeah, I love that. And it's actually a really good example of kind of being in the room with a founder that is just a force, where you're like, okay, this person has that executive presence. And I think part of being a good VC is being able to kind of flesh that out a little bit, right? Where you're like, okay, this person is going to, climb mountains and tear down walls and cross rivers, and they're going to get people to follow them, right? And that's a little bit of the, the art of this business, I think, right? Because you can look at traction objectively, you can look at, metrics and even the product, right? I'm a product guy, I build a lot of products, so I look at the product. But really it's kind of like, do you see this executive presence that's going to get, operators and execs from other companies where they make, 2 to 3x what they'd make at the startup, at least in the short term, to join them and risk their livelihoods and careers to work on this crazy idea, right? So it's a little bit of that, you might call that Steve Jobs kind of factor, right? Reality distortion field, or
all of those things, right?
Yeah.
Because you're signaling, somebody's sitting there imagining like there's a killer CMO that we need to hire and we have no business hiring them. Can this person convince them to come and work for them, right? We need the New York Times to go use our payment platform, and nobody there wants to switch anything out. They're, even though they're maybe the most cutting edge digital, media company, they're still 200-year-old media company. How are you going to do that? And if you come in and you let VCs run the meeting, then they're not going to imagine that you're going to do those kind of impossible things that it takes to get two people up to an
So
IPO.
take control of the meeting, be that annoying executive that, just commands the room, basically.
And I think there's ways to do it without being obnoxious.
Right.
I think there's one of the things I talk about in the book is some structure, right? Just a very polite, useful structure. Hey, I'm going to spend the first 5 minutes just making sure we're a fit. And I'll tell you a little bit about the company, and you tell me whether or not this is a good sweet spot for you, or whether or not we're just going to stay in touch or whatever. And then you go in and you say, there's the people who've gotten excited about us get excited about these 3 things, right? And it's A, B, and C. If I convinced you of those 3 things, do you think you'd be going back to your team and championing the team spending more time with us, right? Or is there something else? Like, is there, have you looked at this space and you think it's not three things, it's these 3 other things? You let me know what you're looking for in the space. Cool. And then at the end of the meeting, you circle back. Hey, I tried to convince you of these 3 things. This is what we spent our time doing. You opted into it in the beginning of the meeting, right? This meeting had some structure. Do you think I did a good job here, right? So it doesn't have to be a rudeness or overbearing. It could just be a structured, you've bought into a certain dynamic of an exchange here. And so I created spaces for you to ask certain questions about what I was trying to convince you of, and guided the nature of the conversation. It was a polite, back and forth exchange. And I think you can, listen, anybody who has a sales training background, these conversations are structured. They're intended to get information back from each person, right? And done well, it feels like I'm along for the ride, but I'm not handcuffed, right? I haven't been kidnapped into this. I've been gently guided into an exchange that makes sense and feels productive.
That's great. Well, for any founders listening, you should definitely go read that book. And, I always, know it's a great conversation when we can't even get through the outline. There's just so many questions.
I tend to be a little
that I'm like, there's just no way we're going to run out of time. So why don't we, we'll probably have to have you back on at some point, and we'll talk more, because it's been really informative. I think especially for founders listening, there's just so much that, in 20 years in the industry that you have all these little tips and tricks. Definitely for founders listening, go read the book. I think if you get these kind of recommendations and how-to guides on talking to VCs, I think it's worth. I think there's definitely an ROI to buying the book and reading it, or at least listening to it.
I appreciate that. Thank you.
Well, let's wrap up with some rapid fire questions. If you had to build your Fund One company from the last decade that you passed on with your own money today, who and what did you miss, and what would you wish you had invested in?
So wait, sorry. If I had to redo my Fund One with perfect knowledge, I mean, that's an easy one. He did a really good job generating top of funnel. And I wish I would have had AI help me process the funnel and identify the higher potential stuff, because email is just really tough to manage. And so I have an email from the founders at Plaid that is, hey, we really love your newsletter. We'd love to come and talk to you. And I responded back to them. I used to have this like meeting request tool. So you could like, sort of like a before Calendly. So they requested a meeting like tomorrow, but I didn't get it until like right after the meeting. And I was like, sorry to miss this. Actually, I'm doing an entrepreneur gathering for lunch this Friday. Like, you should join me. Right. And like, they didn't catch that response and I didn't follow up, and that was it. And so like,
Missed.
who knows if I would have invested in Plaid or whatever,
Yeah.
but like the funnel did its job. Like I got an inbound from Zach that was like, love reading your stuff, would love to share. And then it just kind of fell through the cracks.
Man, yeah, I miss Lovable in a similar way, very painful, very painful. You wrote that fundraising is not always fair, but it is winnable. Name the single most unfair thing in the process that founders should stop pretending isn't there.
I think the network side of it, the fact that if you have 5 venture-backed friends, you are at a huge advantage. Take a look at my deck. How do I not screw up this co-founder hire? What am I looking for in a VP of sales? Like the experiential knowledge of being successful on the startup side is not evenly distributed. And you just have to go. There are some founders who are not in the center of those networks that will have to spend 10x the amount of time building those relationships versus other people who just kind of lucked into them or privileged into them or schooled into them or whatever, right? But those people are just better founders because they have that on tap. And it's not fair, but VCs are just trying to find the best founders. And the best founders are the folks that have these networks, frankly. And so, you need to double down on making sure you're connected to everybody you need to be connected to.
Yeah, that's smart. So Steelman, the founder-friendly era, you partly wrote against. What did Brad Feld and his generation get right that your book undersells?
What did Brad Feld and his generation get right that the book undersells? I never really thought about it that way. I mean, when I think of what Brad got right is, I think what Brad gets right is just being a good person in venture. It's just like, Brad's just a really
good guy,
yeah. Right?
Yeah.
And there are a lot of people in venture that I would say are not good people. And I would like to believe that good people, that success disproportionately rewards good people. I do not think that is the case. However, I think happiness does reward good people. I think it's really hard to be an extractor of value, to be somebody who is dismissive of people not like them, to be constantly on the attack, to be constantly in negative conversations with people, in a reductionist of people, and to ultimately be happy and maintain real friendships and all of that sort of stuff. So you can be rich and unhappy, or you could be rich and happy if you're a good person. So I think I'd rather be slightly less wealthy or not wealthy at all and be happy and a good person.
Yeah. And it's not always a black and white decision either. You can be rich and happy. And
yeah, there's levels of rich too.
Yeah, there's levels, yeah.
I always say that when I think of levels of wealth, the way I look at it is, one level of wealth is living exactly where I want to live in the kind of apartment that I want to live in. And we're like, we could use an extra room, but that's about it. Like, we're pretty close, right? And then the level that counts for me above that is majority ownership in a Major League Baseball team. And like, I'm not going to get there. I don't know what's in between there, to be honest. I suppose I could buy art, but like, that's if I can't buy the Mets from Steve Cohen, then I'm fine with the amount.
Yeah, I'm fine flying first class. I don't need to fly private.
Right.
That's like my level of wealth is just, that's fine. That's good for, as a poor boy from Seattle. That's good enough for me.
There you go.
What's a sentence or a message you'd love to send to your 2012 version of yourself, just launching Brooklyn Bridge VC, knowing how it ends now? What message would you send back to yourself?
Don't be dismissive of what you had at first round. And because when I was at first round capital and I went to go pitch, the number one LP question was it like your track record? Is this just Josh Koppelman's leftovers, or like, can you still get good deals not being at first round? And I very much think the answer was yes. But at the same time, there are lots of other things that I should have spent more time replicating, like the value to founders, the mentoring from people like Josh and Howard, and all of that. I spent a lot of time telling LPs I didn't need that stuff because I tried to convince them to invest in my fund.
Yeah.
And I should have internalized some of the things that I had and say, well, obviously this is different, but, here's the way I am leveraging my own version of what I had before. And so I think like since that time, and generally speaking, I try not to be dismissive of constructive criticism.
Yeah. What's a belief about VC that you held dearly but have now reversed or changed your mind on? Or vice versa, something that you didn't believe that you now believe?
This is an easy one, actually. About 50% of the companies that I backed did not have product when I first wrote the check. And I used to think, and it was actually true, that there was a price arbitrage that was worth it at the time, where there were some complex things where you could get in on the cheap for a good team that you had absolute certainty would get to product. Right now, whether it would scale or whether people want to buy it would be a whole other thing. But just like having product, I think people disproportionately paid for it in a pre-AI era. I don't think that's not the case anymore. The bar for product is so much lower that somebody who has nothing is now adverse selection in the way that they were not 5 or 10 years.
Unless it's like deep tech or something like that. But yeah, if this is a software product, you should have something,
Something.
Yeah, before you're pitching VCs for sure. Well, I really enjoyed the conversation. I could have talked to you for another hour at least. Where could folks find you online and find your book and stuff?
So the book is wherever books are sold in whatever format people buy them, although we don't have an audio book yet. And I am actively trying to get my publisher.
Are you going to read it yourself or are you going to hire?
I would very much like to, and we are going to trial some professional readers, and I'm sure they're very good, but I would very much like to do it myself, so we'll see. And all of I continue to write. I mean, I've been writing my newsletter / blog since February of 2004 at thisisgoingtobebig.com. And so I will continue to do that. It's actually very hard for me to just send a version of the book out and where I can't change it.
Right.
But somebody who's a regular newsletter writer, that's very uncomfortable.
Yeah.
So I subscribe to me there. I may contradict things that are in the book, and I'd be totally fine with doing that because the world keeps changing. But that's a good place to find me and my writing and what I'm on.
Well, thanks so much, Charlie. Really enjoyed it.
Thank you.